Hey everybody, Marty Missouri here. It is Tuesday, the 28th of November, 2023. This will be your midweek stock market snapshot coming at you just before the close of trading in the equity markets. Clients, you'll get this attached to an email as tomorrow morning's message. Today I want to touch briefly on my last two written blog posts and highlight what I think are important points that I made in both of those. Then we'll look at the 10-year yield. We'll look at the dollar. There's been a change in that technical picture, which has implications for the equity market. And then we'll look at the S&P. We'll look at the NASDAQ 100 ETF, and we'll look at the Russell 2000, the small cap index. So anyway, and again, we're just about 10 minutes before the close today. Stocks are pretty much doing nothing. I haven't actually looked at volume. I'm sure it's very low. Looks like the S&P is going to squeak into the green. It's up about 10 basis points. NASDAQ 100 is up about 18 basis points. Commodities are having a really good day. Our Ag Futures ETF, which is our third largest position in terms of individual positions, not necessarily exposures, but Treasuries, gold, then Ag, that's up 1.75%. Silver, which isn't huge for us, is up 1.5%. Gold is up 1.3%. Rare earth miners are up 1.5%. And then you get to commodity producing regions like Brazil is up 1.13%, and so on. So yeah, if you're long commodities, you're having a good day today. If you're long equities, you're pretty flat. If you're long bonds, you're doing okay. So anyway, interesting dynamics relative to what's going on in the macro landscape, yada, yada. Okay, so yesterday morning, I shared some charts that I put together over the weekend. Breadth is one of the key inputs to our equity market conditions analysis that we do once a month. And we know that breadth is unusually narrow, historically narrow, or at least it has been this year. That magnificent seven, those seven stocks that have really done all the heavy lifting. Well, exploring that and looking at some history over the weekend, I came up with some points that I wanted to share. So the first graph on yesterday's blog post, I just showed this year's S&P 500, the white line, and S&P 500 equal weight index, the blue line. Of course, the white line is cap weighted, or the S&P is cap weighted, so Apple just has the biggest impact because it's the biggest company on the planet. Equal weight doesn't treat Apple any different than the other 499, actually there's a little over 500 constituents in the index. So just to look at the market overall versus, essentially right now a concentration of stocks. And the canyon is massive. As of Friday, up 15 versus up 1%. And then I said, let's take a look at calendar year 1999. And it was huge going into the last couple months of the year. That's about a 10% wide, which is a canyon of a gap as well, just not quite as wide as this year's, right? But this was historic at the time and has been so ever since, right, up until the current. So basically, I've said there's no shortage of commentary, obviously, in the financial media. The bulls, I heard one on Friday, just said, wow, the broadening out is going to make next year special for stocks, implying that the rest of the pack has got some meaningful catch-up next year. He talked about small caps. He talked about various, value-oriented securities just having a bang-up year next year. And while I always say we're open-minded to such prospects, or all prospects for that matter, we really wouldn't bet the farm on it. So then what I did is I just took the two and I created a ratio, the S&P index versus the equal weight index. So it's going to rise when the S&P is outperforming, or almost by definition when breadth is waning, at least to some degree. And it's going to decline when the equal weight, generally healthier breadth, is outperforming the S&P. So, I would say that in general terms, when the ratio is rising and breadth is narrowing, that's less healthy overall than when the S&P 500 equal weight is outperforming, and it's pretty much a more or all boats rising with the tide scenario. So the top panel here is that ratio. The bottom panel is the S&P 500 itself. The equal weight apparently was created on January 1, 1990, so we go back as far as we can here. But we do capture meaningful periods in modern history. So that massive run up during the 90s, at the time, greatest bull market in history. Notice that coming out of the previous bear market, we had good breadth. So the equal weight was outperforming the S&P 500, so this line's coming down. And we really just had very little volatility, really nothing to graph there in terms of double-digit corrections. And then as we got about midway through and tech began outperforming and the S&P therefore began outperforming the equal weight, suddenly we got choppiness. This was about 9%. The rest of these were double-digit corrections leading into, the early 2000s. Then you could see this big ramp up here later on. So here's how that ultimately played out. The market rolled over. S&P went down 50%. That's what that shows right there. NASDAQ went down 80%. So it didn't happen where the rest of the pack caught up. In fact, the tech stocks caught down and some in literally historic fashion, right? So then we want to fast forward to the next bull market that kind of separated the two bubbles, the tech and then later the real estate bubble. Same kind of thing. Coming out of a bear market, you want to be broadly based. You would definitely buy the equal weight over the S&P 500 historically. And you can see that not a lot of choppiness. So this is just minor volatility. And then late in the bull market, as breadth began to wane, you started getting some real choppiness. Here's how that ultimately played out. So you've got that waning, you got the market beginning to roll over, breadth improving a little bit, or everything's going down, and then this massive spike again, and then look what happened to the S&P, down 58%, peak to trough. Scary times for sure. I remember them like they were yesterday, but again, you see breadth waning and you see the market getting into trouble. So now we're going to go from the bottom of that 2008 bear market through the brief COVID bear market and to, depending on whom you talk to, either the end of the 2020 bear market or just the one bottom before a massive bear market rally, which is what we've seen, and we're pretty much in the latter camp. So this is basically up to mid-October of last year. Just these periods, right, where we had a spike in bad breadth and we had, double-digit corrections. We had the breadth improving, market hanging in there. Another spike in the ratio, which shows breadth waning, 16% decline in here. Breadth continuing to wane on a trend basis, more volatility showing up, 35% correction here, 35 to 40, depending on the index. I guess we'll call that a bear market. It just, trillions of dollars came to bear and it kind of snuffed that one out. But look at the massive run up in breadth even before it started, then of course massive after it got going. Here we had breadth deteriorating and we got last year's bear market. Things calmed down into October, set the stage for this amazing rally that we've had since, but now we'll bring it up to date. So here we are currently as of last Friday. Oh my, look at the massive deterioration in breadth. That's that Magnificent Seven, AI craze, you have it. And here's the market holding up so far. If it's not something to respect right here, I don't know what is. So as I said here, clearly caution is warranted. Okay, so quickly, this morning I got cute with the title, New Sheriff in Town. Can't emphasize enough how markets, monetary policymakers, and politicians are so stuck between the proverbial rock and a hard place. Folks are asking if next year's election gives us any pause in our economic assessment, which says recession odds are high. For, as we know, all conceivable strings are pulled by incumbents to bolster the economy as election time's near. So over the weekend, I did look back at past election years, and most of them are up. Average 4% increase during U.S. presidential election years. However, think back though, folks, 2000 was an election year, and that was the beginning of the horrific tech bubble bursting. 2008 was an election year, and we know what that looked like. So you can have some tough years, historically tough, looking at 2000, 2008, during election years as well, but most of them are up, I will say that. So my answer is, yeah, it does have me wondering if indeed stimulus. And I did kind of hint at something else I've been looking at of late, and that is the Treasury General Account, which has roughly $800 billion in it. And that's money that the Treasury can spend essentially on whatever it wants. And so there is some fuel for the Treasury to do some spending to try to smooth out what could be a rough economy next year. And so again, and as I say here, could ride in to stave off a contraction all the way into 2025. But here's the thing. This new sheriff in town has a penchant for arresting the good feel that would otherwise be engendered by stimulus measures, and succeeded big time, when the floodgates opened after COVID. And that sheriff is inflation. And without a meaningful, not necessarily severe, but meaningful contraction, read recession, odds do not favor a sustainable return to the Fed's 2% inflation target. And a meaningful contraction, of course, is not politically expedient, to put it mildly, for the incumbent team come next year. Hence, the expectation of fiscal stimulus should recession get near the imminent stage, which, alas, would see inflation come in blazing, probably, while putting the spotlight firmly right back on the Fed, who could not simply turn a blind eye, election year or otherwise. So the setup for stocks, folks, is just not attractive, or at least not to the point where we want to add exposure right here as these things play out. If we do get something significant to the downside, particularly if it's recession and lower earnings induced, that's really what we're looking for to provide the opportunities to begin really loading up on our best ideas for the next bull market. And that narrative is something I'm going to spell out in detail in our upcoming year-end letter. So I'll stop there and we'll jump to the charts. So the S&P 500 daily chart, you can see we're pushing up toward those July highs. We've got momentum obviously rolling over as things stall out up here, and we're still sitting just in overbought territory. Really not a good looking setup right now on the daily chart. It's not horrible. You wouldn't have a bearish divergence in either case. If you were to spike back above that and break through there, that would be very bullish. Just looks like this market's feeling pretty heavy right here. On the hourly chart, like I showed you last time, you still have these very definite bearish divergences, right? So you've got an uptrend and you have momentum waning. You see I had a little channel in there we broke out below. You know what that looks like there. So yeah, just not good looking short term. And I said that last week, that I could justify maybe a bullish view between now and the year end, but over the next few days to a week, it didn't look so good. This could morph into something far uglier that does have, end of year implications. The NASDAQ 100 ETF that we track, you can see we are peaking up and testing the July highs. So got above there, gapped up right here. Good looking action on the moving averages. Here's that downtrend line that if we sold off, could get tested here. And then the momentum, these are bearish patterns. You do have what is a bearish divergence right here. So this doesn't look really favorable on the daily chart for the NASDAQ 100. Small caps, looking at the Russell 2000 index. This is the hourly chart. Remember, we had this symmetrical triangle pattern here. And I said that even though we had what looked like a bearish divergence kind of building across there, actually, I said, if I had to, I'm somewhat ambiguous, but if I had to place a bet, I would be slightly bullish here, but anything can happen. And we had a little buy signal in here. That's gone. It's now on a sell signal. You can see momentum continues to roll over. So, and we're beginning to break out below that. So technically, if you're just trading this short term, a break below the wedge would actually be a signal to go short. Again, I said over the weekend that the chart did look somewhat better, and this one still does look somewhat better than the NASDAQ or the S&P, but it does look like you're potentially breaking out below all this right here, right? And you can see that the MACD is beginning to wane. These coming closer together, and you can see it on the histogram, and you can see the RSI rolling over as well. So if you're trading small caps, I'd just be careful in here. Again, seasonality is really strong. I mentioned in the last video, though, that unfortunately for the bulls, sentiment suddenly got very bullish again. It's not the extreme where you begin getting really nervous, but it's there, and it doesn't help the bullish case if people are piling up on that side of the boat as things develop. If this Friday Powell says some aggressive things, and he may very well, that could do a number here short term on equities as well. And then other reasons not to be crazy bullish right here, seasonality or not. Remember how bullish this look was for stocks. This was yields that were technically very bearish. So the 10-year yield falling, very bullish for stocks the way they're trading. Well, look what we have now. We have a falling wedge pattern, right? So the decline is losing momentum. Although today you can see bonds rallied a bit. As I mentioned earlier, this means yields come down. They move opposite of price. But here we have not a bullish divergence, mind you, but we do have the downward momentum beginning to wane, right? And we've virtually a bullish divergence here on a pretty low RSI, not oversold just yet. So this looks kind of dangerous for equities if we did get a pop in yields that might come on, somewhat hawkish Fed commentary at the end of the week, certainly on any positive data that might pop up. And then the dollar, same thing. So a rising dollar would be negative for stocks the way they've been trading. And remember, we called this pretty well, quite frankly, I will say. I mean, we can be wrong plenty, but this time I did say the technicals were really favoring a falling dollar. That was the minority. I love being in the minority, quite frankly. Consensus is too often wrong, but we're never either one on purpose. So anyway, so here you have a bullish falling wedge for certain here on the dollar, and just a touch in oversold territory. You see here when we had a falling wedge and we were oversold, you can see this really nice rally that we got out of that. Same thing here, right? Falling wedge, just touched on oversold, coming out of that. So the dollar and yield setup right now, short term going forward, does not look good for equities. The equity technicals don't look great either. What the market has going for it is, seasonality and perhaps some chasing into year-end. Professional manager, window dressing, that sort of thing too. So anyway, definitely a time to stay on your toes if you're doing this stuff short term. If you're long term, it's a time to continue to be careful out there if you're in these markets. Folks, thank you as always for watching and listening, and I'll talk to you again soon. Bye-bye.